Okay, so our next topic at hand, we're talking about alternative trading systems, and we're really going right into a deep dive. So we're looking at where we stand currently, what are some of the challenges that are in the way, and also what needs to be overcome in order to reach mass adoption. Now, we have a great panel of speakers here that are joining us now, so we're going to go from left to right. So we have David Weild at the end, we have Basil Askari, Graham Rodford, Oi-Yee Choo, Douglas Borthwick, and also Kyle Sonlin will be moderating. So you have your microphone there? If not, you can take mine.
I got this one. Great, thank you very much. Well, hey everybody, we're bringing the energy here, and I actually think we have maybe one of the most fun panels here because the 5 individuals that we're talking with today are some of the most accomplished people in the security token industry. Because we're talking about marketplaces, exchanges, and alternative trading systems in the security token space. So these are a lot of the players that are directly contributing and impacting the liquidity, which everybody likes to talk about. We're talking about trading, we're talking about actually creating and developing capital formation in public and private securities and improving and making that process more efficient. So my name is Kyle Sonlin. I'm the CEO of Security Token Market. We're a media and data company in the industry tracking hundreds of security tokens trading worldwide. And a lot of these players up here I'm very intimately familiar with through the Security Token Show, which is an industry or a media platform that we cover a news show on all of the developments in the industry. So without further ado, I want to pass it down the line and have everyone introduce themselves before we kick it off. I guess we can start all the way at the end with David.
Is this working? There we go. Okay, terrific. David Weild, Alon apparently introduced me earlier as the father of the Jobs Act. So we wrote when tilting at windmills, wrote a bunch of public policy papers that got picked up in DC and actually created some of the ways that people are able to raise capital in this industry. So it's driving capital access. I'm chairman of the board of INX. I'm an advisor to CoreConnex. We run a decentralized investment bank with 120 some odd professionals in 22 states and 4 countries. And we're pretty active in the fintech crypto space. We actually advised Facebook on the sale of their Libra crypto platform to Silvergate Bank. Yeah, we did FairX to Coinbase and lots of other things that we're pretty active in. So we like to be a little different.
Great, and then over to Basil.
Hi everyone, Basil Askari here, co-founder and CEO of Midchains. Midchains is a regulated virtual asset exchange and custodian based in Abu Dhabi, United Arab Emirates. We're one of only 2 fully regulated, licensed, essentially crypto exchanges, so I might be a bit of an outlier in the group here.
Graham?
Hi everyone, my name's Graham. I'm the co-founder and CEO of Archax. We were the first UK regulated digital securities exchange, custodian and broker, and got the UK's first crypto asset permission. So we set up in about 2018 to try and create a credible exchange for institutions to face.
Great, thank you. And keep it going, Oi-Yee.
Hi everyone, I'm Oi-Yee. I'm the CEO of ADDX. ADDX is a private markets platform, and it's a blockchain-enabled one. We are based in Singapore, and we are one of the first to come out of the sandbox with MAS, and so we're fully regulated and licensed private markets exchange.
And finally, Mr. Borthwick.
Hi, I'm Douglas Borthwick. I'm the Chief Business Officer for INX, the INX Digital Company. We did the first ever IPO on the blockchain for a full registered SEC security. We're actually the first security as well to trade 24/7, 365. We own a broker-dealer, an ATS, an interdealer broker, and a cryptocurrency trading business that's active across most of the United States.
So, as you can hear, folks, this is a global panel because we're talking about global investment assets here. Securities laws apply everywhere around the world, and as crypto pioneered, security tokens can also trade 24/7 and to everyone, everywhere. The access is truly unprecedented. So first off, I want to talk a little bit about the types of assets that are really attractive and interesting to our panelists, because these are the people that are seeing the deal flow, and these are the people that are really trying to be in touch with the demand for these types of assets. So what better way to start than talk about what types of assets that we're starting to look at. So we were having a good conversation behind in the green room that I want to kind of kick it off with, and that's maybe the debate between private versus public assets and the viability of that with the, a security token and with ATS. So I want to kick it off with Doug, because I know that you're going to give us a good anchor to talk off of. Where do you see the real value add coming for security tokens? Is it private or public assets?
You know, most folks have come to this conference and they want to talk about private assets. And they talk about liquidity in private assets. But a private asset through a Reg D, Reg S, you're looking at 2,000 holders. So you raise $100 million, 2,000 holders. How much liquidity do you really think you're going to get? Now, INX right now, we've got 9,900 token holders. But the only reason we could get to that is because we did a full prospectus, a full registered security. I think if you want to see liquidity in this marketplace, you really have to start moving and pushing the envelope when it comes down to Reg A's and full prospectuses. Now, certainly, the demand today is for private assets. The Reg D, the Reg S, it's much faster. There's no back and forth with the SEC. But the liquidity isn't necessarily there as much as people would hope for, because again, it's only accredited investors in the US that may purchase something and may never look at it for the next 6 months to a year. The Reg S are folks outside the United States. They may trade it a little bit more, but again, the liquidity might not be there quite as much as a full public security or offering in that nature.
What does our panel think?
Yeah, well, I'm gonna have to slightly disagree here. I think, as always, a good conversation as to what's the difference between public and private assets with blockchain. Where ADDX comes from is the fact that private markets is actually much larger than public markets, right, if you think about it. And probably doubling or doubling in the sort of the next decade or so, just given the capital that's going to private markets. Now, the problem with private markets is extremely complex. Extremely complex. You've got different structures, different tenors, and all sorts of different sort of things that are happening within that. And in reality, I think the true innovation is when blockchain can be used to enable a lot of this, right? The speed, the efficiency, the automation. And I think where I think I sort of disagree for now on, I agree for now on liquidity, because a lot of investors don't have access in the first place. They're not likely to buy something that's very sought after and sell it the next day, or they want to wait for some part of the J curve to sort of kick in before they execute a trade. But I think that that's where we see technology really enabling democratization of these asset classes to the individuals. Now, across the world today, most of that is only available to accredited investors and above, but that's really because of the risk profile that presents itself by size and illiquidity. But once you solve for size and once you solve for liquidity, then I think the regulators have to rethink the availability of private markets to retail. Now, that's a much, much longer game, but I think it's going to happen at some point, hopefully in our lifetime.
Yeah, I think we quite often think about these things as binary. Things haven't been liquid, and now DLT's here, and suddenly everything's liquid. But that's not what we think is the case. Archax, we think every asset's going to be on chain eventually because of the efficiencies, and the democratization happens because the efficiencies reduce the costs, which make it cheaper for people to go and get admitted. So, today you can fractionalize companies by putting them in SPV, issuing thousands of shares. You can already list on AIM and claim liquidity. And DLT doesn't really solve any of these things. But I think what's come out of this whole movement, especially from crypto, is people rethinking about financial services, putting the front end with a risk engine, with a custodian, with the exchange, all in the same place. Suddenly you've removed several intermediaries, makes everything cheaper. So, on ADDX, on our venue, companies can come to you, they can get access, they can get on the market. And it doesn't necessarily mean they're going to have 10,000 trades a second, but suddenly they're somewhere, so someone can make a price. And also, it's not always no liquidity or a central limit order book. You can have a bulletin board, you can have periodic auctions. Things can find the right liquidity market for them. So I think, we need to stop kind of making it binary, find the right market for each asset, and just reduce the cost to make them more accessible.
That's a really interesting point. And I'm interested to hear first if Basil, if you agree or disagree, how you feel about your market in Abu Dhabi, are you seeing that there are opportunities for public companies to leverage blockchain technology, or is it more of the early stage private companies? I'm not sure how the regulation applies. They're maybe not the same shareholder limits. How are you seeing the market forming right now?
So that's a really good question. So the way, at least from a precedent standpoint, we haven't seen any tokenization of private or public markets on blockchain in the UAE. Where the regulatory bodies have gotten more comfortable is actually on crypto, but on large cap cryptos, call it the top 20. And we are seeing liquidity there. There's a lot of action, and I think there's been a lot of PR around the space in the UAE as well. Where I do see things might go in the future is on both the public and private market side. But I think ultimately, you know, what makes one different than the other if the process to get on the market is the same and it's available for investment to retail at that point. Or at least what is defined as retail accredited versus non-accredited, because there's going to be a different definition for what is an accredited investor here versus what is an accredited investor in the UAE, for example.
So if we turn it over to David, the question I have for you is that, especially for private securities, based off of your experience in this industry, do they need to be liquid? This is maybe some argument that I've seen that earlier stage companies are likely locking in investors for a longer period of time for them to actually see the returns that are optimized for in venture investing, in early stage, high risk, high reward styles of investing. They may not directly need that liquidity right away. Do you find that the liquidity argument, especially for private companies, is maybe one that's not incredibly relevant, or maybe shouldn't be the main focus, or do you find that it's a revelation of the technology?
I think that there's a concept of sort of prematurely going public. From a corporate finance perspective, I mean, anybody that invests ultimately wants some form of liquidity, right? I mean, I like to say investors are sort of in the moving business, not in the storage business. It's a function of what your time frame is. Real estate, it tends to be lower because it's a cash flowing asset. Also, that cash flow, if you can pay it out to investors, has a tendency to make it trade more bond-like. There's lots of stocks and lots of tokens that are going to be what academics call like micro-cap securities, smaller shareholder bases that Doug was talking about, that are asymmetrical order book markets, meaning big seller, no buyer, big buyer, no seller. And unless you have intermediaries when they really start to trade that can remarket those tokens or those shares, they don't trade particularly well. They trade down, right? And so just because you have liquidity doesn't mean you're going to have a happy outcome for either the investor or the issuer. Getting a real robust market that trades up is something that is not just about the size of the offering, because larger is better. It's also the structure of the token. The beauty of tokens, which we haven't mentioned, is that you can do a lot of things in structuring tokens and economic interest that you really can't do with a traditional security. And I think that that's where we're going to ultimately see a lot of innovation.
Yeah, Kyle, just on that,
Jump in.
We spent the last 4 years believing in, we really believe in the social benefit of opening markets to SMEs, especially those that don't have access to capital. The problem is, trying to run a market, you go out there and you meet these market makers, and I say, hey, can you make markets on this security? And they say, well, where else does it trade? How am I going to be hedged? Sure, I can do it if you give me cash, inventory, and pay me a retainer, and by the way, you take all the risk. That's the conversation you have. And then they say, well, if you have crypto on your venue, we'll do that. If you tokenize something that's on a main market, we'll do that, because they know they can hedge their risk out. So David's absolutely right. The challenge is we see a lot of these companies and they come to us, and one of the reasons it's taken us so long to get them on board is quite often you've got a bunch of people that have held security tokens for some time, and the second it comes onto our market, what you're going to see is all those investors that have been sitting holding it for the last couple of years instantly come and put them in the order book, and there's going to be nothing on the other side. So there are big challenges with private markets like that, especially on a central limit order book that currently are really difficult to address.
Very interesting. So that's an interesting topic. We can talk about liquidity all day, but I think that everybody has. I also love the blockchain component, because we're not just talking about securities and the opportunities to make these investments more liquid. There is a lot of value in leveraging blockchain and tokenization throughout this process. So I want to throw the question over to Douglas and to Oi-Yee to get their perspective, because they both are operating exchanges and marketplaces that are currently facilitating security token transactions. So how valuable do you see blockchain is in the process, and is that something that is vaporware, or is that actually being leveraged for a value add inside of your platform?
Sure. We started out with the vision of democratizing private assets, right? And we use blockchain because it currently is the cutting edge technology to solve a lot of the post-trade automation work. What I came to the conclusion was not only are we democratizing, we're actually changing the shape of capital markets. Now, whether or not sort of we win in the bond space or the structured product space, I mean, that's a different conversation. But immediately, I'll give you a simple example. We talk about bonds, right? We're allowing SMEs to raise smaller size bonds, speed to market, efficiency. But what we're also seeing is that the time that it takes for the issuer to pay the coupon in cash to the account is almost instantaneously transferred to our client's account on the same day within sort of less than 5 minutes. That happens nowhere else. In every other scenario, bonds are sort of, the cash coupon comes in, takes about 7 days to get into the investor's bank account. So just even that simple example, we can already see how blockchain can be sort of deployed across capital markets, full stop, not whether it's private or public.
Blockchain is remarkable in terms of the transparency. And I don't think people really value this as much. If you go to etherscan.io right now and type in INX space token, you can see every single transaction that happens in our security, a public security, as it's happening. You can then click on the wallet and you can see all the buys and all the sells this wallet has ever made. You can have a level of transparency that just doesn't exist in the current capital markets. Let's say you're in Japan or China or elsewhere. You can pick up your MetaMask wallet using Apple Pay, send money into my ATS, get dollars credited in about 20 minutes, and then buy a security 24 hours a day, 7 days a week. There's no reliance upon the banking system there. You're allowing people to do cross-border transfers pretty much immediately, and you have the absolute full transparency. If I was to ask Nike right now, who are your holders? Well, they have to get a report sent to them from their transfer agent. If I say, what were the last 15 trades? They have no idea. Who are these guys that traded it? What were the positions they had? They couldn't tell you. I could give you all that information in live time continuously. And I think that that's the color and the transparency that's going to change the market. How many hedge funds creep up on someone to buy 5%, and then they have to self-declare that they've got 5%? If it's on the blockchain, you'd see it in live time. The whole concept of being able to do things secretively that are in a back room that we see today in traditional capital markets disappears with the blockchain because the transparency is absolute.
So I think this is really important, and I'm just going to hammer it home exactly what we just heard from the panel. But these are a couple of really strong examples of what blockchain actually does in adding value to a securities transaction. We talked about how it saves costs, right? Graham is talking about how the settlement and clearing process can be incredibly improved in this process. We've got Douglas talking about how these things are more transparent. It allows us to do much more in-depth understanding of who's transacting with these assets. It allows for a much more auditable record of these transactions, which is incredibly important when you're talking about cross-interjurisdictional transactions. Now we're talking about different countries with different laws, and now you can have a very auditable trail of where these things are going. These are demonstrative values that blockchain adds. So going back and passing it back to the other side of the room, I want to ask Basil, you were talking a little bit about crypto and how we've seen this be leveraged a lot in your jurisdiction, and crypto has pioneered this idea of cross-listing and multi-listing, where you want your asset to be on as many crypto exchanges as possible to facilitate more liquidity, to increase access in different countries and jurisdictions, as well as all the other host of benefits that different platforms can provide from DeFi and all this other fun stuff. So in terms of securities, in real-world securities, we haven't seen that's the case. In the dot-com bubble, there was a spree of acquisitions from NASDAQ and New York Stock Exchange in acquiring deal flow, in acquiring investors. Where do you see it going in your jurisdiction? And then maybe we can go around to the rest of the room, but I want to start with you. Do you see cross-listing as a opportunity to connect the global financial system, or do you see it as something that will kind of follow in the paths that we've seen in the past, which is where it's more competitive and not quite as cooperative?
I think the whole cooperativeness is the promise of blockchain to begin with. And we see that most of all, especially when you look at the top 20 crypto assets moving across all the hundreds of exchanges that they trade on, hundreds of custodians, etc. And to bring it back, I think if digital securities are to become more widespread, they should go across. And I believe that that's the direction it should take, because I mean, Bitcoin's a great case study for how this has worked favorably. Is it going to be easy? No, there'll be a lot of challenges. And I like the previous question on kind of the transparency point. It's absolutely important, especially from an AML standpoint, especially in our part of the world, to monitor where these essentially tokens have been. And I can think of a few case studies where, you know, we have active, thoughtful debates with our regulator in terms of how far and how deep do we need to look? And that's going to become more of a factor, especially when assets go across different markets.
Yeah, Kyle, I mean, I'm just going to mention that one thing I neglected to say in my bio was that I was vice chairman of NASDAQ, and I ran the listings businesses globally. You know, when you look at the ATSs, right, you know, all the different alternative trading systems in equities markets, which there could be 60 of them at any particular point in time, they're all trading every one of the securities, right, that are listed on both NASDAQ and the New York Stock Exchange. So, the listing, what is a listing, is a question, and it has a peculiar definition when you're looking at stock markets, because there's a set of standards that the company has to reach, right? There's also a sense when you get into crypto, when you're taking tokens, that people are just posting them and they're calling them listings, but there's no standard per se, right? It's not that you're going to get listed or delisted. All you're trying to do is get the same level of, if you will, visibility with investors that you would through the ATS market in the US on the equity side, which is naturally picking up basically markets in all the listed securities, if you will. So, but I think
there's also fees, right? Each exchange, you know, NASDAQ charges their listing fees as well. So there's those pieces.
Well,
too.
yeah, but I mean, by definition, that's correct. But it's, you know, what the corporations are looking for is that imprimatur, which says we've made a certain standard, and that's not so much the case, less the case, if you will, in crypto per se. But you know, these markets are still to this day, I mean, they're very inefficient, right? And people are making, particularly smaller investors, are making lots of money trading crypto. Why? Because there's inefficiencies, you know, latency, arbitrage, and so on, and you can move in, and the price points are wildly different. I mean, they really deviate quite a bit, and there's a lot of manipulation going on. And it's international in scope, right, which is different when you're dealing with ATSs, which are all regulated under a common regulator that kind of forces everybody to have convergence so that you can have this notion of best execution. It doesn't really exist yet in crypto markets, and I think that stuff is coming. I mean, it gets a big look. One of the reasons why I'm associated with INX and CorkINX is because they're both through the front door of regulation, embrace regulation, you know, and we've had a lot of cowboyism in these markets with some of the early adopters, and I think it's just a matter of time before, while regulation gets more comfortable, regulators become more comfortable, and legislators with what's going on, that they start to promulgate basic, you know, protections that have always existed and been developed over the last 100 years in equities markets, currency markets, and derivatives markets, right? So, I mean, there's going to be convergence, if you will, in terms of the rule book in all of these token markets.
Yeah, I'm really glad you brought up arbitrage too, because I think this is a really fun one. With security token market, we track a lot of data, and so we actually have seen some cross-listing examples happen here in the US. Exodus did a $75 million Reg A Plus security token offering, which was groundbreaking and revolutionary for the industry, and they're actually listed on 2 different ATSs here in the US, and we're preparing reports and a lot of analysis on those arbitrage opportunities, which we've been able to replicate in-house and actually be able to capitalize on. So there is arbitrage opportunities, which presents this opportunity for market makers or others to enter into the space. So I think that I don't know if anybody has any thoughts, but cross-listing potentially creates arbitrage opportunities. And maybe the question I have is that a healthy way to generate liquidity? Is that potentially toxic by splitting up the focus for investors across multiple platforms so you can't concentrate the liquidity? Do we have any thoughts around that piece of it?
Just on the, I mean, obviously You know, we're all kind of, everyone I know in the space is willing to work together to facilitate as much liquidity as possible. You know, pretty much everyone on the panel and that I know here, we're all working together. This idea of you know, a rising tide lifts all ships. And I think in theory it's easy, right? You know, you get a lot of liquidity somewhere, you get a market maker sitting in between you, they equalize the price, you get a more efficient market globally. But the reality is with securities, it's very difficult to have that actually achieved. You know, quite often you're following existing regulations. To David's point earlier, being listed really does mean something. Be admitted to our venue means something completely different. A market maker in one region may not be able to face someone else. You may need to create a depository receipt. You know, in the traditional world, we had an Australian company approach us to be admitted to our venue. They have to be registered in CHESS, which is the Central Securities Depository in Australia. They have to have that position reflected in Belgium, which is then reflected in the UK, which is then on our venue. You know, you have to navigate these quite complex scenarios currently. So Oi-Yee's point earlier about, you know, what does blockchain really bring, hopefully it can start streamlining some of those processes. So I love the idea, but the reality is getting a security listed on our venue in somewhere like the US, there's quite a few hurdles to make that happen seamlessly.
But I think the point around the desired state, if you think about what's happening with things like crypto and NFTs, it's really about the globalization of certain things, right? Whether you, whatever you call them, assets or what have you. And it is sort of showing the potential financial services use cases, 24/7 trading, you know, liquidity pools that decentralize. And I think digital securities at some point will start to look somewhat like that. But I think it's much slower and much harder because of the regulatory constraints. But I mean, I think some harmonization, some basic harmonization might just solve that quite quickly.
I was going to add that, you know, all digital securities are not the same, but also all ATSs are not the same. All transfer agents are not the same. There are some ATSs that do custody on exchange. There's other ATSs like ours where you can take the tokens off the exchange and you can self-custody it in a MetaMask wallet. There's some folks that do books and records, you know, the transfer agents, but you don't need a transfer, you just need books and records for a private security. And some of them will work for some exchanges, but not for other ATSs. Or they'll make it hard for you if you're listing their tokens to actually, you know, open up their whitelist to you. There are other times where I want to list, let's say in Archax, and you're right. I mean, it's you know, when we talked about doing it together, it was weaving through so many different relationships that in the end it makes it very, very hard for us to do. And so you think I have a digital security in the US, I can cross-list it all across all these different countries, but you find out through either custody reasons or for books and records reasons, or even just for I have a public security, I can't just list that over at an ATS in a different country unless they're also following certain guidelines that are given to them. And they say, well, we're not with the SEC, we're outside the US. I'm like, but I'm a US registered security, so I have to follow my rules. So there's lots of different rules that are in place that I'd say are blockers somewhat, but it's not just that, it's also because there's so many different forms of, even an ATS, some are, I can list digital securities, others can only list digitized securities. Now it sounds like a very similar name, but it's actually completely different. And so, you know, once you get into the depth of what we're dealing with here and you actually understand that everything is not the same, you realize that, you know, we talk about, you know, regulations are being really tough, but that's just, you're just scraping the surface when you say that regulations are tough, because as you get into it, there's so many striations of these regulations, it's crazy.
Do you find that definitions are a common pain point between all of the different partners that you may need to work with, as well as regulators and investors and everybody in between? Do you find that you're spending a lot of time just getting on the same page about what all this stuff is and what the process needs to be?
Well, I think that everyone wants to do things the way that they feel comfortable doing it. And I think at some point they'll come around to the way that INX does it, which is the right way.
Any other thoughts around that? Do you spend a lot of your time regulating, or excuse me, educating your partners and regulators and investors and different providers? Is that still, are we still kind of in that point of the growth phase of this industry? Is just a lot of it is just educating? Because I certainly feel like that's most of my day.
At least from our side, it definitely is. As far as the entire kind of ecosystem of stakeholders, there's always an education component, even with counterparts in the crypto space globally, for example, who come to the Oi-Yee thinking that they understand how the regulations work when they've done business elsewhere, for example, but it's not the same. And I think that's an interesting segue to talk about passporting. So I do believe that passporting specifically for things like digital assets as a whole, including crypto and digital securities, is super important across border to get this idea of assets and tokens going from wallet to wallet in different exchanges in different places and having that cohesion. So that understanding of if it's compliant in one jurisdiction, or at least its domiciled jurisdiction, then it should be enabled for trading following those rules. I don't think we're there yet, but I think that's where it should go.
Right, that makes sense to me. So that's I think potentially where we can continue this. We saw, with the Jobs Act came out, it was revolutionary in the ability to increase access into these types of investments. 506C has become a tremendous opportunity for issuers to more accurately target and reach out to people who may be interested in participating. And we actually saw how those rules can change. The SEC and FINRA came together and they issued some changes, increasing the caps on Reg CF, which made it a much more viable exemption for smaller issuers, and Reg A+, increasing that to 75 million. Are there things and small wins that we can try to work towards, not only just in the US, and maybe we can start there with David, but also I want to hear from our international panelists as well. What are some of those small wins we can start to work towards that might significantly improve the access of leveraging security token technology with ATSs and exchanges?
Well, I say, look, the Jobs Act, actually, there's been, what Congressmen call Jobs Act 1.0, 2.0, 3.0, and then Pat Toomey's got a version, which is 4.0. Congressman that he's, proffering. Congressman Emmer, who was here, I'd worked on his Main Street Growth Act, which was a venture exchange with a different rule book to provide actual economic incentives for market makers to make markets and re-engage in these smaller, more difficult stocks to support. In the instance, and this is an interesting thing, the clients, or meaning the corporate issuers, generally are more concerned about how do I raise the money, and less concerned initially about how it trades in the aftermarket. And the problem is that if it doesn't trade well in the aftermarket, it can really slam the door on raising more cost-effective capital or getting a liquidity for insiders at attractive prices. So that's why it's so important to think about both. The FINRA, the Financial Regulatory Authority of the United States, was actually all over the broker-dealers saying, look, you guys are talking about liquidity by listing tokens, and you guys need to do diligence, meaning the industry as a whole, on the tokenization platforms and on the aftermarket, because we believe that people are over-promising liquidity. Just because you tokenize something, it doesn't mean that it's liquid. And then are you going to be happy if something was issued at say $10 and now it's trading at $1? Is that the kind of outcome you're looking for? So holistically, we have to be really thoughtful about what we push out. And I know that INX, we were talking about this, and I won't mention the name of the issuer, but there was a group that has 600,000, if you will, followers, participants. I mean, that has the core of something that probably could trade well in the aftermarket because it has a following, right? So affinity marketing, very important. But if you do some of these things that are small, that are going to trade in a lumpy fashion, and you try and trade them in the public market, they are not going to be liquid, and they are not going to trade well, okay? And so being thoughtful and understanding that one size fits all doesn't work for issuers. Large cap, whether it's tokens or it's stocks for that matter, is not the same as micro cap and less well-known, less affinity group kinds of companies. So it's just think about it from beginning to end and think about where it's going to be. And one of the proxies, the substitutes that we use to get these things to trade better when they're smaller capitalization is frankly yield. It's dividend distributions and things like that make securities trade more bond-like. And then if you get to a certain market cap, maybe you can eliminate that yield or that yield instrument. But there needs to be quite a bit of thought that goes behind it. Otherwise, you shut the door on subsequent financings because nobody wants to buy something at 10 that trades down to 1. Right.
Fascinating. So yeah, that's our cue to start wrapping up here. So I do want to give one final question, which I think is interesting. Anybody can jump in if they want to, since we don't have time for everyone. But with the recent crypto struggles, do any of you feel like it actually maybe validates the fact that we're tying real assets to these investments because there's actually something there to be able to invest in? Investors actually have rights to anything underlying their investment as opposed to crypto? Obviously, we don't want crypto to fail, of course, but at the same time, does this kind of help validate some of the reasons why it maybe makes sense to think about more structured investment products?
I'm not so sure on the underlying asset. Obviously in cryptos, understanding the value under something is always quite difficult, but it does make everyone pay attention, I think, and question. A lot of people saying regulation's a bad thing. I've never really thought it. I don't find it that difficult to follow the rules, and frankly, I quite like knowing who I'm interacting with at all times. So when you're looking at what's going on, and no one's questioning the mechanics of things that people are piling money into, it raises some interesting questions about who's responsible, especially in the cases of a DAO, who's the accountable party, and people are, losing their livelihoods. There's a bunch of developers building on something that doesn't exist, and it raises interesting questions for people like us who want to do crypto and securities. Who is responsible? Usually as a market, we take no real responsibility for the issuer and the underlying, and we certainly don't have the expertise to, go into Terra and UST and question how they'll behave in every scenario. So, it makes you stand back and just pause and say we need to be really careful. At least with a digital security, it's a company, there's ownership, there's governance, you can look at their accounts. When you're looking at these stable coins, you think, okay, it's stable, it'll be okay, and suddenly it's not. And even if you look at layer ones, I used to think layer ones are probably okay, and then, Terra's, dropped like a bomb, and suddenly they're not. So, it's made us certainly pause for thought and think it's much better when there's someone accountable for the underlying.
I think if it's anything that's going to react at the back end this week, is our regulators are going to be very focused on what on earth just happened. And I think it'll be rippling across globally, right? Again, it was maybe not as relevant when it was not such a big market, but it is now so big that I think 43% of Singaporeans apparently have crypto. And all of a sudden, it's a structural issue. And I think they then have to reflect how they're treating securities versus what's happening in the crypto market. So there will be a lot more regulatory scrutiny for sure.
I think that Luna ends up, it may actually be good for regulation. Good because you've got exchanges that list things not because they've done the due diligence, but because they've gone out there and said, how many people are trading this? Oh, I should list it. That's not really a really good thing. When you're offering something to the retail general public, you should probably do some due diligence. And that's just an idea that I have in the back of my mind, because you shouldn't be offering stuff to people just because they want to buy it. If you're an exchange and you're offering it to retail, you should have an idea. And I think that broker dealers and ATSs have to do due diligence before they bring something to listing. I think that's important. When you look at stable coins, we list, I think we list USDC and we list Z dollar and GN. Each one is backed one-to-one with the currency. They're regulated in some fashion by NYDFS or somewhere else. And again, there's some regulation there. If you're buying a stable coin, you like to think, what's behind it and is this regulated? So regulation comes into it. Now, I think enough people had their fingers burned in Luna that now they turn around and they may think, you know what, maybe regulation is a good thing. 2 weeks ago that have said, regulation, I'm not for that. I'm a Bitcoin maximalist. I want to be away from the government. But when people lose money, they turn around and say, you know what, I wish the government was there. And I think that that's going to be helpful towards us in that it does help push the narrative from a lot of folks, a lot of retail folks, that before it said, I've got no interest in regulation. Now they say, I wouldn't mind a little bit of protection. I'd like someone I can sue if I lose a lot of money. And I think that maybe helps our industry.
Tim Draper was talking a little bit about, the failure rate and the like. Can I have a second? You had this during the internet bubble, right? From 1996 to 2000, 2001, you had a massive increase in bubbles. There was a big correction, but out of that kind of primordial ooze and innovation, we had massive companies emerge and massive products like iTunes, and eBay and Amazon.com that sort of reorganized the world. And this is exactly the same thing is going to happen with this technology.
And with that, if everybody could join me in giving a huge round of applause to an amazing panel. individuals. They'll be outside. You got to network with them. Thank you very much.